The Federal Reserve Bank just announced that they're planning on changing course before the end of 2025 because they just finished their June meeting where they said two very important things. Number one, they said that they do not want to cut interest rates right now. And then they said, number two, that they're planning on cutting interest rates a couple of times before the end of the year. And that change of tone got some investors on Wall Street very excited, but others don't believe what the Fed says. For example, an economist from JP Morgan Chase Bank said this in response, quote, "We continue to look for only one interest rate cut this year, and they're anticipating it at the end of the December meeting," essentially saying, yeah, we'll believe the Fed when we actually see interest rates get cut. But if we go beyond interest rates, Jerome Powell, who is the chairman at the Federal Reserve Bank, also gave us some interesting insight into what's happening in our economy today, more specifically talking about inflation, the economy slowing, and interest rates potentially falling. And I want to talk about those things in this video. So let's start by talking about inflation. Because what Jerome Powell said about inflation is this, quote, "What we're waiting for when it comes to cutting interest rates is to understand what will happen with the tariff inflation. There's a lot of uncertainty around that." Essentially, Jerome Powell says that we could see the prices of things rise. In fact, that's exactly what he said. Quote, "The cost of tariffs has to be paid." What does that mean? Tariffs are a tax. It's a tax on businesses and people that are importing products from foreign countries. And if you have to pay 10, 20, 40, 100% more to bring that product here, your costs go up. And when your costs go up, generally, you're going to pass that cost down to consumers, meaning you're going to charge more money to sell that product. Or you could eat up that cost and shrink your profits. But many businesses will have to ultimately raise their prices. And this is where he says that you should expect more inflation ahead. This is what Jerome Powell said, quote, "We are beginning to see some effects, and we do expect to see more of them over the coming months," meaning we're already starting to see some prices of things rise. And he expects this summer that we're going to see more inflation hitting the prices of things, which is why he says he doesn't want to cut interest rates right now, because if he starts cutting interest rates right now, that could make the inflation problem from tariffs even more strong. With that, let's talk about the economy. Now, we've been covering all of this in Market Briefs. Again, Market Briefs is my free financial newsletter for investors, where every day my team is working to break down what's happening in things like the economy, housing, stocks, crypto, and global markets into a fun, witty, and easy-to-read newsletter. It's read by hundreds of thousands of investors every morning. And when you join Market Briefs, you'll also get my investing masterclass as a bonus, where I'll walk you through how you can get started as an investor and how you can find hidden investment opportunities before everybody else. So if you want to get Market Briefs plus my investing masterclass all for free, all you have to do is click the link down in the description below. Now, when we talk about the economy, Jerome Powell essentially said that he is expecting the United States economy to get weaker in 2025. But he did give some props to the economy. He said this, quote, "The U.S. economy has defied all kinds of forecasts for it to weaken." Essentially, everybody's been predicting a recession. Everybody's been predicting the United States economy to get a lot weaker, but it really hasn't gotten weaker yet. The economy is still strong. But he still believes that we're going to see a weakening in our economy because of changes in economic policies. In fact, he says that we're going to see the economy grow by 1.4% instead of 1.7%, which is already kind of a lower-ish number. And then they went on to say that the unemployment rate is expected to go up to 4.5% instead of the previous expectation of 4.4%. So the Federal Reserve Bank and the government essentially believes that unemployment is going to go up and our economy is going to slow. And this is what Jerome Powell had to say about that. Uncertainty about the economic outlook has diminished but remains elevated, meaning that concern about a recession is not here right now, but people are still kind of worried. Then he goes on to say the risks of higher unemployment and higher inflation have risen. Kind of everything that I just talked about with tariffs, with concerns about changes in the economy. People are still worried about jobs going down and also inflation getting worse. And this brings us to the topic of interest rates again. Now, I already kind of talked about how Jerome Powell and the Federal Reserve Bank said that they don't want to cut interest rates right now, but they'll potentially cut interest rates by the end of 2025, maybe even a couple of times. And we've been hearing a lot of people compare the United States to foreign countries. We recently just got the news that Switzerland cut interest rates to zero, and their central bank said that they might even make interest rates negative, which is a weird concept, meaning banks are getting paid to borrow money. And here we are in the United States, and the Federal Reserve Bank doesn't want to cut interest rates because of tariffs. But in addition to the Fed saying they might cut interest rates a couple times in 2025, they also said that they're predicting less interest rate cuts in 2026 and less interest rate cuts in 2027 than previously expected, because they think that tariffs and economic slowdown will prevent them from continuing to cut interest rates. Now, I want to remind you that generally when you do see a recession, that leads to more interest rate cuts, because cutting interest rates is a way to stimulate the economy and to encourage spending. So if the economy is weaker than expected, that could entice the Fed to cut interest rates more aggressively than expected. So for those of you that want to see lower interest rates for a cheaper mortgage or for a cheaper car payment or refinancing, whatever, in essence, we need to see a worse economy to justify those lower interest rates based off of the information that we have today. Now, with that, let's talk about what all this means for you. And if you've been watching any of my videos, you know that this is why it is so important for you to become an investor, because there's a lot of things happening in the economy. We're hearing news about the economy potentially slowing down. We're hearing news about inflation potentially being a problem. But this is where it is so important for you to invest. And recently I've gotten a lot of messages from people saying, well, Jaspreet, what are your thoughts on a financial advisor? And I want to talk about that just for a second, that it is great for the right person. There are good financial advisors. There are also bad financial advisors. So if you are going to work with a financial advisor, that's fine, but treat it like a doctor. Get multiple opinions and talk to them to make sure that they're aligned with your goals and you're not just blindly following a random financial advisor. So yes, they can be good. Yes, they can help you, but it also helps when you have that basic level of financial education and financial knowledge. That way you can go to a financial advisor and ask the right questions and know what your goals are. Now, I did make a partnership with a company called Pickle. They are a sponsor from Minority Mindset. So if you are interested in finding a financial advisor, especially if you have assets to invest, they can help you find a licensed financial advisor who can help you manage your money at no additional cost. So if that's something that you're interested in, you can check out my sponsor, Pickle. I have the link for you also down in the description if you want to potentially get matched with a financial advisor at no additional cost. Now, when it comes to you investing your own money, you got to know what is your goal and your strategy. And ultimately what this told us is we're going to see a lot of uncertainty ahead. There's tensions in the Middle East. There's still tensions between companies and oil, and there's tensions with different countries with trade. When you have all those tensions, you get uncertainty, and that uncertainty is what Wall Street hates. And that's what creates volatility. What is volatility? Stocks going up and down. And when you get that volatility, people tend to panic, and a lot of people tend to lose money. How do we know? Well, let's just take a look at the first few months of 2025. Remember when tariffs first became a thing? Markets fell very hard, and then they were paused, and then markets went back up, and then tariffs were announced again. Markets crashed hard again, and then the tariffs were paused again, and markets went back up, and then tariffs were announced again with Liberation Day, and markets crashed again until they were paused again. Now here we are in June, getting ready for what's going to come in the beginning of July, because the current tariff pause that we have going on right now is set to expire on July 8th. And that's when we're going to hear from President Donald Trump and what he wants to do with tariffs. Now, we don't know what he's going to do, and I'm not here to try to predict what he's going to do or what's going to come with that, but what I want you to understand is there's a lot of uncertainty. All of the uncertainty means volatility. All the volatility means a lot of emotion is going to come. And that emotion means a lot of people are going to lose money. But it can also create a buying opportunity. Because if you are a long-term investor, if you are investing for the long term, 10 plus years, what happens over the next 6 months or even 2, 3, 4 years is not that important. Because if markets go down, it creates a better buying opportunity. And what you want to do is be a long-term investor, meaning work to accumulate assets. You want to own more assets, period. And nobody knows what's going to happen tomorrow. And this is where your goal should be to accumulate. Now, when you see those downturns, when you see a crash, when you see a recession, it creates a great buying opportunity. So it's nice to have some extra cash waiting to be invested, but a lot of people try to perfectly time the market. They want to wait for that perfect time to buy, and they're the same ones that end up missing those opportunities. We have seen this happen time and time again. When 2020 happened, I was making videos about why I was buying during the crash, and I would get comment after comment of people saying, Jaspreet, they're buying too early, markets are going to crash even further, it's going to go down way further, and then ultimately markets went back up because the Federal Reserve Bank opened up the money printer. I didn't expect that to happen that fast, but it did, and a lot of people missed that opportunity because they were waiting for markets to crash way further. We saw the same thing happen in 2022 when we saw the stock market fall by 20%. Talked about how I was buying, and many people missed that opportunity because they were expecting markets to fall by way more than what happened. Same thing happened in 2025. When tariffs happened, people panicked and sold, and then people said, oh, it's going to get much worse. And then we would get this news that tariffs are paused and markets rallied back up. You don't know when things are going to change. You don't know how far things are going to go down. I mean, sometimes things can go down for years. Other times they go down for a day. We don't know. What you want to do is be a smart investor, know your strategy, and be willing to stick with it. And that requires you to, number one, have the money to invest, meaning don't spend all of your money, and then come up with a strategy. Again, that is the financial education that you need to be investing in, is knowing what type of investor you want to be, what are the things you want to invest in, and how do you actually go out and execute. Because if you're investing in ETFs, it's a very different strategy when you're investing in ETFs, index funds, and mutual funds versus when you're investing in individual stocks. And the game that you want to play is going to vary depending on what's right for you. Personal finance is personal. That's why you shouldn't blindly trust a random guy on YouTube. Do what's right for you, but that requires you to invest in your own financial research and your own investor research as well. And with that, I'll see you on YouTube tomorrow.